Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Wargent Property Buyers. I'm here with Chris Bates from the Flint Group. G'day, Batesy. How's things?
Things are well, Pete. Not too much to report on, right? It's in this sort of weird zone between winter and summer, but spring has absolutely popped here. Just been playing a bit of football. Got into my fasting actually again. I've been, on a bit of a health kick for the last year and a half or so, and I respond really well to it. I've been about 2 weeks in now, and saying that though, about half an hour time, my 16 hours is up. So as soon as I finish this podcast, you watch me in the kitchen. It's going to be a sight to see. But what's news in your world, Pete?
Cooking up a storm. Yeah, well, hopefully you can make it through the half hour without passing away. So, look, it's same really. Inquiries are still ticking along pretty nicely, but it's a funny time of year. I guess just building up into the spring selling season, but not much slowdown with us really. Things are just ticking along, and you'll be pleased to hear I booked in a haircut for this week at your suggestion last week. So I've taken notes, and I'll be looking newly shorn for next week's podcast. So there's a bit of stuff going on in the news this week. US jobs figures was the main thing internationally, and they're pretty slow. And actually, they were slow enough at the headline level, but once again, the preceding 2 months of jobs figures were revised right down. So basically, we were already certain, I think, to get interest rate cuts from this month in the US. The debate now is whether we get 25 basis points or 50. I don't really know. The markets are split right down the middle. But I think there's definitely that happening, and that's going to change the global narrative. I think all the stories in Australia, there's just so much, there's just so many news articles about housing supply. I saw Master Builders Australia has cut 53,000 from its pipeline housing forecast. So they already thought we would miss the 1.2 million target, but now we're going to miss it by even more. The ASX, this is from the AFR, ASX listed home builder Tamerwood. Executive Chairman Robert Lynch said, I didn't think it was realistic when it came in, and it's less realistic now. It's going backwards. So, and then just a whole stack of other stuff. Another piece in the Australian, exit of Chinese developers continues to pick up pace. Hans Holdings Group sold a site that had been working on for a best part of a decade, a $3 billion project at Hyde Park, basically a whole block there at 38. I can't remember which number it is on Pitt Street now, 338, I think. And and Housing Minister Claire O'Neill said we've got 90,000 shortage of construction workers, so we need to bring in more people for that. So nearly all of the stories in Australia is about supply shortage in the housing market.
Yeah, well, hopefully you don't cut your whole hair off, Pete. Are you gonna shave it, or are you just gonna take a little bit of a trim?
No, I haven't had short hair for probably 15 years. So I don't know. I think I'd be like Samson without it, but at least a bit of a trim. So it's getting a bit out of control if you're watching on the the video version.
I was going to try and negotiate a 50 basis point cut, and you shave it all off, but I don't think that's going to happen. But I mean, I think there's a bit of jawboning going on, right? The RBA basically saying, no, rates are going to stay high for longer. And, they're trying to not let the horses bolt, right? And I guess it's the same back in 2020, 2021, rates are going to stay zero forever. Leverage up. Don't worry, rates are going to stay low. So I think there's a bit of that going on, though. But when you look at the data, right, everything's pointing to the story that inflation is getting back in the bottle, and, rate cuts are coming. I mean, we've absolutely seen just in the last 2 weeks, there's a little bit of FOMO in the market, and we don't like to create it. We just like to listen to how clients are feeling on their first call. And then when they're actually going through the buying journey, often they'll come back to us, a month or 2 months in and say, look, this is what I'm seeing. I'm seeing a bit more supply in what I'm buying. I'm seeing really listings. I'm finding it really hard with my budget. I keep getting blown out. And that's probably the story we're seeing at the moment, is that a few people who thought they were in with a really good chance on a number of properties and probably could have secured those properties very early in the campaign, even though just 3 or 4 weeks later, they haven't bought them because they thought they'd go to auction and, buy them under better conditions. All of a sudden, they've rocked up at the auction and there's a bit more demand they expected and the properties run on them. And so I think that's where we're at the moment. I do think there's this overconfidence a little bit that on listings and, there's so much stock on the market and there's so much choice. Well, don't expect that momentum just to continue the full spring period. I think that, these weeks can tick over pretty quickly. We all know how fast life can go. And all of a sudden, we're into October and, mid to late October, and it starts to get a bit dicey to list your property in November. And so just be careful. This time can really go quite fast, particularly if you're a buyer and you get too pigeonholed on one property and you get laser eye focused and you start designing all the furniture and the painting and you're obsessed with this one property, and then all of a sudden it takes a month for it to do the auction and then you miss out and then you're back to square one. So be careful, just trying to chase one rabbit in this market. I would say, have a few different options and, maybe you don't have the time to wait for the best option always.
I think you're right. I mean, if you look at bond markets, they always run ahead of what central banks are doing. And if you look in the US, market pricing is for a huge amount of easing over the next, the next 15 months or so. Australia, the same. If you look 18 months out, market pricing is for a cash rate target of about 3.2%. So that's potentially 4 or 5 rate cuts. And also just listening to what people say when they phone up, as you said, Chris, just listening to investors and home buyers. And the general vibe now is people are looking further ahead and they're just looking towards lower mortgage rates. So people borrowing today might be borrowing at 6.5% or thereabouts, but people are starting to factor in that potentially they might be paying 5.5% at some point, maybe a year or two from now. And it has a massive change in terms of the dynamic. It just sort of brings forward a few purchasers. And there's I suppose, less fear around. That was the big thing. We went back a year ago. People just weren't sure how far this sort of rally would go. I guess now people are starting to think, well, probably we're about at the peak and probably there'll be some respite. So, yeah, that does change market dynamics. As you talked about last week, there's been an increase in listings, but from very, very low levels. So, yeah, it'll be interesting to see how that plays out over the rest of the spring selling season.
Yeah, I think if everyone's wants to kill that hole, there's lots of choice on the market. Just go SQM research, type in total property listings. You can go, all the way back to 2010, right? And it's all free. Don't have to worry about paying anything. And you can see no matter what city you look at, you can break it down. Sydney, Canberra, Hobart, and Perth, and you can see. Hang on a sec. 10 years ago, there was 20-odd thousand properties on the market in Perth. Right now, there's 13,000. That's Perth's an example. But, if you look at Brisbane, back in 2014, there's maybe 30-odd thousand properties on the market. Now there's 15. So, has there really been a lot of listings on the market, or are we way down on long-term levels? And listings supply, right? That's obviously the amount of choice buyers have on the market. And you got to think these cities have a much bigger population and a lot more pent-up demand in 2024 than they did in 2014 as well. So, bigger population competing on a fewer number of properties on the market with more pent-up demand and a lot more recent migration who haven't bought. Sydney hasn't, it's probably similar to what it was 12 years ago, but there was a bit of a boom back there as well. But population of Sydney is way higher than it was 10 years ago. Definitely jump on SQM property listings and you'll really understand that a lot of the storm in a teacup that listings are up dramatically, it's just not true.
I wonder sometimes whether those numbers get a little bit distorted when there's a surge of new supply, because I suppose if you get a new tower block, you're not going to see necessarily every single property listed for sale. It's the same with rental vacancies. I think at various points in the cycle, the rental vacancies can be understated because one advert might relate to 10 new apartments. And I think back in 2015-16, we maybe saw a bit of that. So, but nevertheless, very useful indicators and actually really good free market resources there from SQM Research. There's stacks of stuff there for rental yields, asking prices, by suburb, by region, nationally, by state.
Region's
So you can pick it all out. So very useful stuff from Louis Christopher and the team at SQM. Let's crack on with these three big news stories of the week then, Chris. First one then, lending starts to pick up the pace. So the ABS puts out its monthly lending indicators figures. I see they may well be shifting back, I think, to quarterly again soon, which is a shame. But then I suppose there's other places that you can pick up indications from CoreLogic and other places. But anyway, lending for housing was up 3.9% in July. It was up by a massive 35% over the year for investors, and big increases in all four of the biggest or most populated states. And it was up 21% over the year for owner-occupiers. A couple of the things that stood out to me, Chris, loan sizes for owner-occupiers were, well, basically a record high, 640,000. I wonder, you would probably have a better handle on this than me. I wonder whether a part of that, though, is driven by some of the lower income earners just being locked out or pushed into investment housing. The first home buyer numbers, again, were pretty robust. I think about a third or so of first home buyers have been helped into the market by government incentives. But construction lending, again, disappointing, actually falling. So more people may be buying new homes, but actually borrowing to construct, that environment is not good. So I guess in terms of what comes next, we're below record highs for total lending. But I guess if you strip out the refinancing, we'll be very soon back to record high lending. Surprisingly bullish, I guess.
Yeah, absolutely. I think, the total loan commitments and higher new loans is absolutely what you said. You know, a part of the market that can borrow is buying right now, and that's the higher income portion of the market. But that's under ridiculously tight borrowing capacities. And I don't think there's been much of a jump in the average loan over the last few years. It's kind of stayed quite steady. But when rates do get cut and borrowing capacities go up and prices go up, ultimately buyers will have more confidence to borrow up to their limit because rates are on the decline, and B, they know they have to because ultimately they have to enter the market that they've got to spend everything they've got. And so I think we're going to see a big jump in the average new loan when rates get cut and borrowing capacity goes up. And so, but, the overall leverage of the property market, I think the AFR did a big roadshow on property the last couple of days. And, I haven't gone through it all yet, but, a lot of people are saying it's a debt-fueled property market. Well, hang on a sec. It's only at 22% gearing. How's that actually been driven by debt? It's been driven by intergenerational wealth and people mental accounting of just reinvesting profits back in property. It's not all debt, and people are paying off their debt. So, yeah, what's your take on that, Pete, and whether property prices is being driven by debt or whether it's been driven by just pure equity in the market?
It's an interesting one, isn't it? When I look at the ABS figures, and I do periodically once a quarter, and they look at, yes, as you said, the total debt in the market. So the housing market, I think the stats are actually out this morning, the day we're recording, but the housing market valuation overall, if you multiply median price by number of dwellings, it's about 11 trillion. But as you said, the debt, I don't know what it is on today's stats, but call it 2.5. It's about 20 to 25% gearing. But I suppose, there's some sort of mental models that I've found useful in the housing market. The first one is to think about prices at the margin, because that's where prices are set. So obviously gearing does have an impact at the margin, setting the marginal price. The other thing that I've just noticed over recent years, and this was something that Doron Peleg and the guys at Riskwise showed to me in a research paper, is just how investors amplify the cycle these days. I think if you look at the ABS figures for investment lending since, basically over the past dozen years, if you look at New South Wales or Victoria or Queensland, the investment numbers are up and then they're down and then they're up again and then they're down again. And then there was a big surge up until, I guess after the interest rates were cut to zero, and then they slowed down again, and they're up again. So I think the number of home buyers in the market is somewhat stable through the cycle, but it's the investors who come and go, and that really amplifies the sentiment in the market and also the price action. So, if you look at what's happened recently, I guess probably yes, all four or even five of the most populous states have seen a big increase in investment lending over the past year. Interesting to note as well, there's been a lot of talk about landlords selling up in Victoria, but on these numbers, you would say, well, it looks like there's plenty of new landlords coming into the market as well. So maybe a potential sentiment shift afoot in Victoria. But yeah, those would be my main points. You're absolutely right. The gearing level overall in the market is low. But of course, there will be some households that are over leveraged. And at the margin, yes, new people, new borrowers coming into the market is effectively what can set the marginal price. But as you and Simon Kustenmacher, the demographer, have talked about, we've got an enormous intergenerational wealth transfer to come probably over the next 15 years or so.
Yeah, I do like looking at these lending numbers because it shows when there's been previous lending booms, right? And you can very clearly see the 2012 to 2015 boom in Sydney and the 2019 sort of 2020 boom as well, right? But in those booms, people bought different properties. A 2015 sort of boom, a lot of people were buying apartments, right? And, you know, a lot of people were buying high-density apartments, the depreciation benefits that people believed were good for them. We were stopping people trying to buy the apartments in that boom, but absolutely a lot of foreign investors as well, etc. And it was mainly driven by Sydney, to be honest. But if you look at the other booms, a lot of that 2019, 2020, that was the COVID boom. It was the second homes. It was the regional areas. And you can see that it was, particularly on the East Coast, where a lot of investors bought regionally. And now I think that boom sort of ended a little bit. And I think this boom is a little bit about the more the affordability part of the market. And, the cheaper properties, and Perth in particular and Adelaide have, taken up, because it's more affordable compared to other states, have taken a lot of the investors. And I think a lot of the investors in New South Wales are actually first home buyers that are actually just buying, an investment property because they can't afford to buy a house. And I also think it's a lot of potentially cashed up, people with a lot of equity buying investment properties, and actually also buying investment properties for their kids to live in, and et cetera, and people buying their future retirement homes, I would say. And so I think that the reason that matters is that every time a boom happens, it reallocates where our rental properties are going to be. And particularly if at the same time you see a lot of investors bailing. And I don't think a lot of investors bailed post the 2017 boom. I think some did in the 2018, 2019, because it was pretty scary with royal commissions and refinancing and things like that. But I absolutely think a lot of investors are bailed over the last couple of years, and People Research absolutely backs that up. Their next annual report comes out in the next few weeks, I believe. And so we'll cover that on this podcast because I think that'll be very good reading. But ultimately, the properties you could have rented 2 or 3 years ago are different to what they are today. And over time, that's happening naturally anyway. Less investors are buying houses in, say, capital cities because they're becoming more affordable, and they're buying more apartments, or they're buying more regional, or they're buying more, cheaper, townhouses and things like that. So rental supply doesn't stay fixed, just like housing prices. The availability of rentals changes every year. And I think in the last couple of years, there's going to be a big shift in what you can and can't rent versus, say, 5 years ago.
That's an interesting point about people buying second homes or buying properties for their kids or helping their kids onto the ladder. It's one of the real paradoxes of the housing market, isn't it? The wealthier people get, the more properties they buy effectively. And it just seems to be the way that land values... wealth gets capitalised into land values in Australia. I saw Shane Oliver at AMP had a graph of total returns from residential property versus the stock market going back over 100 years. And I think the total return was 10.9% for property and 10.7% for the stock market. It's near enough makes no difference, the same return. I guess it kind of makes logical sense to me. I guess as people get wealthier, they look to invest their money. But if one asset class gets ahead of the other, or if one looks relatively cheap, then there's a reallocation of capital, but there's not much really to pick between the total returns over a full century of data there. So pretty interesting. Let's take a look at this second news story of the week. Keep home ownership away from corporates, piece in The Australian. So Chris, you'll be glad to hear I went through and sat through the housing episode of Q&A this week. I must admit, I didn't watch it live. I watched it back on triple speed just to get the gist of it because, those things can be a bit of a talk fest usually. And there was a bit of talk about immigration and students. And then someone said, scrap negative gearing. And a buyer's agent said, remove stamp duty. Someone else talked about speeding up approvals and da-da-da. One of the interesting things that's just sort of come out of this is build to rent. And it seems to me that that's going to be a bit like nuclear versus renewables. This is going to be a juxtaposition of the next election. So Labour is really positioning itself with the Housing Australia Future Fund and potentially investment funds within Australia to sort of promote build to rent housing models. So institutional investment, whereas the opposition, the coalition, is now sort of standing against that. So I guess this is the backdrop. Article from Macro Business this week. Annual unit approvals in Australia crashed to just 58,000 in July, the lowest since 2012. At the capital city level, the situation is even worse, 45,000, a level last seen in 2010. So that's the backdrop. Massive decreases in New South Wales, down 72%, Victoria 68%, Queensland 65%. So there's loads of headwinds for the home building industry. Labor wants to cut taxes and provide incentives for the build to rent model. But Andrew Bragg of the coalition wrote that the corporate ownership model of the US kills the Australian dream, so the home ownership dream. So look, in some US cities now, US corporates own a very large share of the rental stock. In some cities, it's 20, 25%. And it seems like as we approach the next election, Labor's going to push the build to rent model and the coalition's going to probably take the other side of that bet.
Well, I think the coalition's going to go pretty hard, right, to try to win this election and win some votes. I think they're going to throw some big carrots to the first home buyers, particularly about accessing super. I think you're just going to watch that. That is going to get some real speed behind it. Particularly, the build to rent model, I've looking at this in the past, I think there was about 30 or 40,000 apartments potentially in the pipeline. On the back of what is it, 11 million dwellings, Pete? How much are we at? 10 or something?
It's about 11, I think.
Yeah,
I think
exactly.
The stats are actually out today. So by the time this goes to air, the latest figures will be up to date for FY24.
So, it doesn't take a rocket scientist to figure out, hey, we've got 11 million dwellings and we're going to create 30,000, not just this year. This is over the next few years. This is the total pipeline for build to rent, right? Like, it's not going to move the needle. And absolutely, they're going to create some better rental, and particularly if it's in the more affordable part of the market and the key workers. I think that's where they should be supporting as much as they can versus just the normal market. We need people in our cities, and they need somewhere to live. And if they can't afford to rent, then they can't afford to work, and then we've got a whole issue. So I think absolutely, if you can encourage some corporate build to rent, if the government can give up some land and also maybe keep hold of that land so they get the land value increasing. I don't know. I think I'm all for it. I think if particularly also if you target different rental pools as well. Maybe it's divorcees or single parent families, and it doesn't just have to be stereotypical couples and families buying. There's lots of people who need rental accommodation. Particularly, it's also the older generation. Some of the biggest problems with homelessness are over 50s and women in particular, and so. Build to rent is when you haven't got a lot of investors playing in this market because they're not signing up to the high density apartments like they were, like I said, 10 years ago, believing that was the secret ingredient to growth, and they've been taught a lesson, and all the building issues coming out in New South Wales and Victoria, etc. I think I'm all for build to rent. I just don't think it's going to move the needle. And I do think if they have to potentially put their hand in their pocket and reduce some taxes to make the feasibilities work, then why wouldn't you do it? Supports the construction industry and it creates us more rental accommodation. And so I don't think it has to be either or. I do that, but then I think the Liberals helping first home buyers is an interesting one, right? All you're doing is kicking the can down the road. But if you've got people, first-time buyers wanting to enter the market right now, and they're trying to enter the market after all the other cans have been kicked down the road, why shouldn't they get a chance of entering the market? It might not make it hard. It will make it harder for generations 5-10 years down the line, but they've already got their back up against the wall and the tide against them. So, what's your take on that, Pete, in accessing super and a lot more first-home buyers incentives?
Oh, yeah. I guess anyone who's a realtor or works in the industry loves the idea because it's just more money for housing. I guess it probably goes against, though, the purpose of the superannuation system. So I think it'll be a difficult one to get through, is my gut feel with the Senate. I think the flip side to your point on build to rent, I mean, is really just a fast forward and look at what might be the case. So if you look at figures from the US Government Accountability Office, particularly through the global financial crisis, there was a lot of purchasing in bulk of foreclosed homes and turning those into rental housing. By 2023, corporate housing funds held $1 trillion of assets just perpetually rented out. And it was 25% of the rental stock in Atlanta, 18% in Charlotte, 21% in Jacksonville. The reason this was interesting to me is that there's generally now pushback from the Democratic or progressive side of politics in the US trying to stop predatory investing through corporatizing the rental stock. And in fact, there is some support on the Republican side as well. So that's why it's kind of interesting, because in Australia, the Housing Australia Future Fund is one of Labor's main policies, which will promote institutional investment. And they've already sort of committed to cutting the withholding tax rate for developers. And I guess there's been a bit of banter from the Association of Super Funds referring somewhat derogatory manner to sort of the mum and dad investors, calling them sort of hobby investors, or referring to it as a hobby activity. So there's a bit of a battleground building up. I think, corporate housing has got a role to play, but in some parts of the world, particularly the US, it's a big chunk of the housing stock, and it's certainly moving that way in London. A lot of the new supply comes through institutional investment. I suppose the argument is that it provides security of tenure and the potential for long-term leases. But there's some downsides as well, particularly if it ties a load of people into long-term renting who might otherwise be aspirational first-home buyers.
Yeah, I mean, they can still get out of build to rent, right? You could sign up to a lease and maybe it's 2 or 3 years. So you don't have to put all your home ownership dreams down the toilet. I think Assemble is an interesting one. Chris Daff, I interviewed him on The Elephant about probably 5-6 years ago now, and he was coming up with an innovative idea to basically do a rent to buy model where you basically rented the property, and at some point, you create some equity in it and you actually own it. And that model's been quite successful. He's been able to pitch that to super funds and get the Victorian government on board. And it was just an idea in infancy back then. And he's got a few case studies, and all of a sudden, the big super funds are willing to back it. And so hats off to him and that success, because, getting supers to invest in resi housing has been ridiculously hard. And he seems to be one of the only ones who's actually been able to get money hit the bank. So well played there, Chris. But I do think this build to rent model is just part of this thing. When whether we get to 18-20% of our rental stock, that is years and years and years and years down the line. It would probably give a lot of options to a lot of people. Who's to say that people can't still do things for themselves? But I'd rather have rental security than having no rental security and potential homelessness problems, or a lot of other issues that come out of not having housing security. So, I do think it doesn't have to be either or, but I do think it's going to be a key part of our housing market long term.
All hands to the pump. Yeah, certainly a lot of articles about the need for more supply and the need to build more. So let's wrap it up with the third news story of the week. From the AFR, office values down 22% and falling. So higher mortgage rates or higher interest rates have compressed yields. Working from home has obviously reduced demand for office space. And there's been loads of articles about a bottom in the market, but it hasn't happened just yet. I think my reading is some of the A-grade office space is doing okay, but the sort of B and C grade, not so much. And this is now a worse decline than the global financial crisis. So 22% so far. And it looks like if you look at MSCI's analysis and also some of the sort of investment bankers and Morgan Stanley analysts, they say there's more to come effectively. And I suppose it's a bit unlike in the resi market where you've got lots of touch points for valuation. Well, it's a bit murkier, the valuations in the office space. And it seems that over 2 years, we've seen a 22% devaluation. And I guess it doesn't look like things have slowed down if you look at the latest ASX releases. There was another sort of recent sort of moment in the market where Dexus offloaded 425 Collins Street in Melbourne. And I guess, it was a sort of a sale at about 40 million. So that points to about a 20% discount. So they didn't talk much about it, but it sort of does suggest that around about 22% is how much we've seen. And look, I suppose there's two sides to this. One is that interest rates will most likely come down, I suppose, over the next couple of years, which will help the space. And I think there is a general move back to the office, even if it's been slow. But the other thing is that cap rates have picked up about 125 basis points now. So, I guess cap rates back to around sort of 6% or thereabouts across the sort of big real estate investment trust. So getting back to the sort of level where investment might make sense again. So, Chris, you're sort of more in the city than me. What do you see happening in the office space?
Oh, look, I do think hybrid work of some sort is getting quite embedded now. I think more and more employers are, coming up with the right policies that's going to suit their organisation and get the most out of their workers, but also give the workers the best, work-life balance and actually, get fulfillment from work. I don't think working from home full-time, is the right option for everyone. I do think it works at certain times in life, but also to grow teams, there's got to be some type of collaboration face-to-face, I feel, and whether that has to be weekly or fortnightly or just quarterly probably depends on the organisation. But I do think there's a pressure both, and I don't think in this job market where there is a talk of recessions and things like that, like those who are seen, are they the first ones who get the promotions and are less likely to get cut, or the ones who are working from home? And I do think that's putting a bit of extra light. And actually, you know what? I need to go and show my face because there's less positions on the tree, and I don't want to lose that ability to jump or some whippersnapper take my job who's working long hours. And so I think that's obviously playing into this as well. But let's say we assume that hybrid work gets truly embedded, then a lot of firms may need less space, but it's not like you've reduced the days 40% in the office, so we need 40% less space. I just don't think the maths are that simple. And people come on different days. If everyone comes on the same day, you need the same space. When you want to do events and more meeting rooms and collaboration and Zoom rooms and, more, free space so people can actually want to come into the office. So I do think that ultimately if our population keeps increasing and we keep increasing a portion of our economy to knowledge-based sort of city workers rather than farmers, and manufacturing, etc., then you can see naturally our CBDs or our major work hubs are just going to get bigger, and more people are going to be coming into them. And particularly when you've got launches of things like the Sydney Metro, and it makes it easier to get to the city from places. Well, the commute's no longer such a burden; it's actually enjoyable. Well, I'm happy to go to the city 2-3 days a week versus that crowded bus. So. I don't know. I think you're pretty brave to bet against cities. People did it in COVID and said no cities would ever come back. Well, you look at foot traffic in Brisbane, it's actually higher than it was pre-COVID from my understanding, maybe not so much in Melbourne. And I think if you could, get yourself a good building, whether you retrofit it and you don't knock it down, and there's carbon benefits to doing things like that, but or whether you actually repurpose it to resi, there's absolutely a few projects and buildings that make sense for that, or whether you just land bank it and then potentially take advantage of it in the next build cycle when there's a real undersupply of grade A stuff getting built. At the moment, it feels like we're just going to keep building, AAA office towers for fun because we've seen a lot get built in the last 5 or 10 years, but historically, we haven't built anywhere near as much as we have. It was just a real boom that we saw in the office towers in our capital cities. Is that your sort of take, Pete, that don't be too gung-ho? The other thing with a a lot of these buildings are owned in ETFs, they're owned in big funds, and the office isn't doing well, but maybe the industrial or maybe the high street or commercial property has many different lenses to it, from supermarkets to etc. So a lot of those funds aren't performing ridiculously bad. Maybe the towers aren't doing very well, but the other parts of the market are sort of propping them up. You do see a bit of syndication where accountants make a little bit of money packaging up these investments, and they make a bit of an application fee and a service fee. And I do think those accountants that put their clients into office buildings and put a fair chunk of people's super into office buildings are going to be finding it quite tough right now, because a lot of investors would probably want to bail, but they can't get out of these longer term, syndications.
Well, that is true. You're right. So some of the big real estate trusts, they've got very diversified portfolios. I think just on the to wrap up on this, interesting point that Morgan Stanley made, reported in the AFR article, and that is during the global financial crisis, cap rates jumped 175 basis points. And that's a lot more than we've seen so far, 125 basis points to date. So, I mean, if you take that at face value, we could have another, it's another, I can't do the math, 40%. So that implies another, from 22% decline in office values. What if we saw another 9% decline? That would take the total cumulative decline to over 30%. And that's when things would really probably start getting messy. I think, as you said, yes, generally, it's been a difficult time for real estate trusts to raise capital, and they've been doing it at a discount because investors have been jumpy. But there's certainly other parts of the commercial space that have nowhere near been hit to the same degree, like in the industrial space or supermarkets. So, yeah, I think bit of a gut punch, I suppose, if you've got office exposure, but maybe across the sector, alert but not alarmed, I suppose, and investors will start to look for discounts at some point. I think, as you said, I mean, in the US, there's been some catastrophic declines. In Canada, the same in some of the office valuations. But Australia's been a bit cushioned because we've had enormous population growth. It's very concentrated, I suppose, on Sydney, Melbourne, and southeast Queensland. That has probably made a difference as well. But nevertheless, quite a decline, I suppose, 22% and more to come. So, I think that's about it for this week. I think just to wrap it up, lending starting to pick up the pace quite strongly, actually, for housing in July, and probably we'll be back at new highs fairly soon. A lot of discussion on Q&A and elsewhere about housing supply and how we do it. And office values down 22%, worse than the GFC. So it's not all sweetness and light, but I guess we'll most likely pull through.
Yeah, absolutely. Obviously, another week into spring, Pete. Let's keep tracking this sentiment over the next few weeks and what listing numbers do. And I think we're all going to be surprised that, hang on a sec, time's ticked over. And, we get to that October, November time, you'll naturally see listings start to dry up. Yes, there's some people who, secure properties in sort of October, November, and then they've got to sell their property and they have to put their properties on the market. But a lot of people choose not to once you get to that middle November time. It's just too risky if the property's going to sit on the market over January. And you could easily see sentiment flip quite dramatically from that, middle of October to sort of late January time. It's a long time to be just sitting there and waiting for listings to come on. A lot of buyers can get ready. And so just be careful. If you're in the market right now, just be careful you don't miss out if you're really keen to buy and all of a sudden you're sort of picking up the scraps in November, and then all of a sudden you get a bit of FOMO and you end up buying the wrong property, but you missed out because you just weren't as sure of actually securing a property in September, October. Not to say you should just buy anything, but if you've got a great asset in front of you, don't just sort of play it too cool for school thinking you've got lots of choice. That the market can teach you a lesson pretty quick. Is that some of the things you usually say to your clients, Pete?
Well, yes, and try and take a long-term focus, and things are rarely as good or as bad as they seem in the media. So, I think that's about spot on. So don't forget, you can jump on the Rask community forum. It's a great resource there, all for free. And drop your questions in the property section, because we do use those for the Q&A episodes on the podcast. And if you've got any questions about mortgages or lending, or you just want to have a chat with Chris and the team, just click on the link in the show notes. And similarly, if you want to have a chat with me about buying property, always happy to book in a call. So I think that's it for this week. Have a terrific weekend, everybody. And thanks again, Chris.
Thanks so much, Pete. Happy Sunday, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.